This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. David, welcome to the show. Honored to have you on because I know many of our listeners are going to relate to your story today and going to learn a lot. Tell us a little bit about that story and let's dive in about who you are.
Well, thanks, Whitney. Great to be here. I'm a recovering Fortune 500 sales executive who got into the real estate world. I had golden handcuffs, and I used them to parlay that into a successful career in real estate. Short answer is I was laid off twice in 18 months after having hit deliverables and through no faults of performance or reality. And I've come to realize that I have a story to share with people. It's not a matter of if you lose your job in the high-performing sales world, it's when. And my objective here is to teach people how you can take your golden handcuffs and actually make them golden feathers so you can build net wealth for your family. When it's all said and done, I'm a general partner in 1,000 Doors, and I'm based in Denver.
Awesome. Well, you mentioned, it's not a matter of if, but when. If I was in that position, that might make me a little nervous to hear that. Potentially, I don't know. But speak to that person a little bit. It's thinking about, hey, maybe this is me, maybe it's not. Maybe describe that individual a little bit that you're speaking to when you say that.
Yeah, and that individual is who I was. I was seat 1D on the airplane. I like it on the aisle on the right-hand side because I'm left-handed, so that way I can write and not hit anybody. And I cross my legs that way. So that was my chair. We're the guys that get up on a Monday morning at 6 a.m. We go to the office for 5-7 hours, catch a 3 p.m. flight. We come back Thursday night at 5 p.m. and we hit 1, 2, maybe 3 cities. We've got teams that we work with. We have pressure to hit SOX compliance issues. We have pressure to hit quotas. Now with technology the way it is, we have pressure to put everything we do on a CRM that allows us and our management teams to maximize performance through dashboards. And the reality is that we make great money because we're under great stress and we get paid to survive that stress. However, the world is such that corporate America looks out for itself and they never look out for you, the top performing employee. I literally made budget for the 9th consecutive quarter in a row the day before the quarter started. And I got laid off the next day. And then everybody else at my level got laid off that same day because of a merger. And the new company decided that they didn't need the executives that were doing what we were doing. So I've been there. I've done startups with tech companies. Came in one day, got a Series B funding round secured. And I actually met with a VC guy yesterday and was telling the story, and he totally understood it. And I came in and I said to my CEO, okay, we got a business plan to hire 35 sales executives. Let's go. And she said, I paid off all my debt. I said, what debt? The next week I was laid off because I had reversed 5 quarters of negative revenue decline. However, we couldn't get the needle fast enough to keep the doors open. And if you're in the startup world, this is a very familiar story.
Yeah.
If you look at Amazon or you look at Twitter or you look at anybody in the news right now, we're recording this the first quarter of 23, and layoffs are prevalent. It's the same thing that happened in 2000, same thing that happened in 92, same thing that happened in 2008. We go through cycles. And if you're a high-performing sales guy, you're going to lose your job. Just a matter of when. And if you don't, you are a unicorn. I can't tell you the number of friends I've had that have gone through this. And unfortunately, none of us have horns on our head, so we're not really unicorns. We have golden handcuffs and we hate.
I have seen numerous ads where at Google, Facebook, just tens of thousands of layoffs, as we speak. I would mention that LifeBridge is hiring though, which maybe that seems odd, but we are for a few positions. Maybe I'll reach out to Google. But anyway, no doubt, David, it's like, with the W-2, and it was I wasn't a high paid sales guy by any means. However, even when I had a W-2, it was just something I knew that I couldn't see myself doing forever. But everybody in my family and sphere of influence at the time did see that as this quote, secure position, right? And you had benefits and it was the golden handcuffs, like you're talking about. It was like, oh man, what are you doing? You can't quit that. It's so good, right? But man, it was exactly what you're talking about. But I would love for us to dive in to help those individuals to be prepared, right? When this happens, right? Like you say, how can you help them to be prepared for that?
Well, the first thing you got to do is you got to make a plan. And you got to look at your taxes. There's an old adage that it's not what you make, it's what you keep. I remember during the first Gulf War, I was literally looking at my tax burden and I was buying a missile every year for the US government. And I remember I was at my grandfather's funeral, actually in Virginia, as it were, and we were laughing about this. And that's when I really got to pay attention to the tax structures. And one of the beauty benefits of real estate, if you make a plan, is that you can create tax strategies to defer tax, to reduce your W-2 tax burden, to actually lower your effective tax rate. One of the things as a W-2 employee is that you don't have a whole lot of deductions. And with the Tax Act change in 07, we really changed it out. So one of the things that I did was I opened a side hustle company, which wasn't called a side hustle back then, but it allowed me to create a different stream for some revenue. Was it legitimate? Absolutely. Did I have a legitimate offering? Absolutely. Did it affect my W-2 effective tax rate? It dropped it by about 9 points, which might not sound like much, but if it's $100,000, that's $9,000. And if it's $500,000, 9 times 5 is $45,000. That's a new Mercedes at that point.
If somebody doesn't think that that's much, I'll just call me. I'll be glad to take that off your hands.
Yeah, you can write a check. It's David, MCIL, right? No problem. Yeah. And so first is build a plan. Second, you have to look at your retirement structures. One of the things that used to drive me crazy was when I was in the advertising business. So I worked for a division of Viacom, and they had a very poor 401k match. And as a highly compensated employee, I couldn't contribute to Roths. I couldn't contribute more than the 2% average above the company norm. So I think I was capped at 7% contribution levels. And so I had to go find other alternatives. And the rules have changed since then. And now you can do things with Roths that are bigger. You can do things with self-directed IRAs that really were not germane at that point in time. And if you don't have a self-directed IRA and you have all of your money in your company 401k plan, you're sitting on a block of dynamite. If your General Motors employee and GM goes bankrupt like they did in 08, what happens? If you're an Amazon guy, and let's say that Bezos figures out a way to monetize the next magic and Amazon falls in value. If all your eggs are in that W-2 employment basket, you're not diversified. And one of the things that we do with alternative investments in the real estate field is we create some diversification. So putting money in a self-directed IRA and buying real estate in a self-directed IRA, or in a solo 401k if you are eligible to buy one, or a self-employed IRA, a SEP, is another great way to do this. So that you actually structure things in a way that you have tax deference. It's not avoidance, because you're going to pay the man at some point in time. But the less you have to pay, the better. I don't know, I'm kind of talking in a high level, but if you think about it from how did Mitt Romney run for president? And he had $100 million IRA. It's one of the questions my father asked me back in, I think he ran in 2012. I don't remember the exact year. But the reality is that he had a self-directed IRA. And he put compensation in there and let it ride. If you put compensation in, or if you roll over when you're changing employers and you roll the money over from your previous 401k to a self-directed IRA, there's no contribution requirement that says you've got to only put in $5,000. You can roll over an entire process when you change employers. If you're not doing that, you're leaving money on the table. Or if your 401k is too high, you can roll over a percentage of it. The ultimate question is for people that are in anywhere above 30 and older, is that we are now the first and second generations that have to provide our own nest egg for retirement. There is no pension. There is no safety net, right?
Yeah, you better be thinking about it. That's for sure. Early as possible.
Right. And like my dad was a 28-year vet. And so he's got a military retirement. He's got an American Airlines pension, and he's got 4 streams of income. If I don't use my handcuffs to build other income streams, I'm living only off my principal. And as a highly effective sales rep, that's like living off of the current client base with no pipeline for new biz. It's a kiss of death.
Yeah.
And I think it's crucial that people investigate that stuff.
I wanted to just back up just a little bit, though, because one of the first things you said was make a plan. And I know this can seem pretty overwhelming, right? We're already pretty scared because we think we're going to lose our job, or we know we're going to lose our job. But we're talking about IRAs and Roths and self-employed IRA and some of those things. Who could we talk to, to figure some of this out, or any recommendations on where to educate ourselves a little bit better on what path, or even how to make a plan? Because it can seem daunting, well, I don't even know what I should consider. I just hear it often, right? Well, I don't even, who do I even talk to figure out what my plan should be?
So let me walk you through what my experience was. And I'm not going to give any names for anybody specifically because I think everybody has their own situation. I will tell you, I'm getting ready to launch my own podcast focused on this called Break Your Golden Handcuffs. And I will dive into this in depth. But the basics thing is I started talking to my accountant. I started talking to my financial planner. I started talking to my trust estate attorney. I started talking to my human resources department. And then I started really researching what the options were. My accountant said to me, you got to have some deductions. Go build a company. So I did a side company. That immediately allowed me to have a series of deductions for legitimate business expenses that I couldn't maximize because I was at a compensation level where the deductions were capped. But in a business, you can have ordinary expenses aren't capped. They're not capped. It's a one-to-one deferral versus ordinary income. So that's a big part of it. The second thing was that I was able to build a structure where instead of getting income paid for my business, I got paid dividends. So I talked with my accountant to work through how do you get paid different systems. A dividend is paid once, maybe twice. A constant paycheck is pretty self-explanatory. And the difference in tax rate is one is at normal tax burden and one is at a 15% capital gain structure. Big difference. Short-term, long-term, depends on their situation. And so you start to think about what can I do to add to my tax complications, to add to my picture, to make it more complicated in essence, but it actually simplifies it. So if you're a passive investor in a real estate business and we go through cost segregation and you get a loss of $25,000 a year to use, that devalues over time as you make more income. But there are ways to carry that forward if you talk with an accountant. I'm not a CPA. I just did this by myself because I had to learn it. And what I learned allowed me to have commissions from 2000 still making me money today. Bonuses from 2012 are still making me money today. And the objective when you're working with those people and you're in corporate America is to build yourself, not a golden parachute, but a safe place to enjoy life. And I think that that plan starts with those three professionals, your trust attorney, your accountant, and your financial consultant. And then I would spend a lot of time looking at guys like myself or guys like you who make our living helping people build their net worth.
Yeah, for sure.
I don't make any money unless somebody else makes money first.
That's right. It's interesting when we started the business and all that stuff, we're having to learn all that ourselves as well. Right. But for me too, right. I mean, as far as IRAs and whatnot and leaving a W-2 position and thinking about, hey, what do I do with this? Now that I'm self-employed. Are you about to start a podcast or producing a podcast and tired of doing the editing yourself? We have produced over 1,000 daily shows, and the production team I've created called Vox Valens Media is now available to produce shows for you as well. We can do as little or much as you need, from finding and communicating with guests, preparing introductions, to editing the audio and video. You will sound better, have a more professional presence, and be able to spend your time doing more valuable tasks in your business. Let me know if you're interested by emailing me directly at whitney@lifebridgecapital.com. And maybe speak to that transition a little bit and what that looked like for you, but then also what does this look like as far as, this IRA? Do we have to do it immediately? That transition, can it sit there for a while? How urgent should they feel about making this happen?
Well, I never want to put somebody in a sense of urgency around their own retirement structures. I have a quote on my wall from Marcus Aurelius that reads, "No theft of free will reported." So everybody has the choice of how they want to do these things. What I would say is it doesn't take long. I was able to open my solo 401k and my self-directed IRA, each of them, in about 15 minutes. I found a third-party bank. I filled out the forms. I then ordered I have Schwab, so I guess they'd be my brokerage, to transfer money as an approved transfer from Fund A to Fund B. There's no difference in the mechanics, except for you can't hold it yourself and you can't personally benefit from it yourself. But if your IRA or your 401k is funded by your earnings, the IRS views those as separate entities. So imagine that I'll just talk first person. There's David, then there's David's 401k, then there's David's IRA. To the IRS, I'm three different people.
Yeah.
And when you get that hurdle in your plan, you can understand the difference. And as far as my transition goes, I was in corporate America, that second layoff of the tech company. I was in the middle of a divorce and I couldn't travel anymore because I became a single dad of kids that were in middle school and elementary school. So I chose to leave corporate America at that point in time. And I got into real estate because I had built a nest egg from my golden handcuffs. And I decided I couldn't live on a plane and be a dad. I could, but I chose what was valuable for me and my family, and I will never regret it. So that's how I got to this world. I didn't want to leave corporate America. It's just life happened and it put me on a path. And as far as moving, the timing on this kind of stuff, I've got a friend who's in the high level insurance guy, and he and I have been talking about it for 18 months. So at some point, he'll see the returns from one of our offerings and he'll decide, oh, that really was good. And until that time, we keep talking about it, because the reality is that there is no time that's better for anybody than anything else. There is a hypothesis, though, that you buy real estate and you wait. And so if you can't buy the real estate yet, you can't start waiting. If you're waiting to take action, inherently, you're losing something.
If you wait till you need the funds, you don't have time to wait.
Right. And it takes about 45 days to do the whole thing when it's all said and done, depending on who your providers are like. Some providers are faster, some providers are slower, some take 90, some take 2 weeks.
Yeah.
So it's like everything else in America. Everybody's got their processes and their systems, but it's not overwhelming.
And most people don't realize, and I'm glad you brought it up, that you can't benefit from these funds, right? So you can't do certain things. But I mean, like you want to go buy a rental property, you could use this for that. However, you can't go work on it, right? Or somebody else has to do all the work, or it has to be
your family can't live in it.
Right. That's right. That would be benefiting, right? Or your child, or
gotta be an arm's length transaction from anybody, right? Yeah.
Yeah.
And the thing that's fascinating about these that people don't talk about is if you own it free and clear for 366 days, there's no boot. So there's no unrelated business income tax or UBIT. So one of the models that I've had people work with is that you go out and you buy a rental property. I also own a residential brokerage in Denver, but you buy a rental property, you put it on a 15-year mortgage, and you buy in your IRA. So your IRA can actually incur debt. From that debt, you can pay it off in 15 years. You hold it for 16 years, you own it free and clear. No tax benefit. Your IRA has this thing. You bought it for 200, you sell it for 400, you got a $200,000 gain that's free and clear. 16 years in the making, right?
Yeah. Wow. What if you paid it off, like you just paid cash for it and owned it for a year?
Well, great. More power to you. But if you pay cash for it, you got to have enough money in your IRA to do it. In Denver, the average cost of a rental property is $450. The mean house is $550 in Denver. So most folks don't have $500,000 sitting in their IRA.
Yeah. And you wouldn't want to put it in one property if you did.
No, you want to diversify, right? That's part of the plan.
Of course. So any other just steps that somebody should know, or that maybe is going to hold them up when they start this process, or frequently asked question that holds everybody up as well as they're looking forward to this from this position?
How do you provide providers? How do you vet the providers? So from that point of view, it's pretty easy to do that research online. If you have questions, you can always ask me. I'm happy to help you. I use solo 401k. I use a local bank in Colorado for the self-directed IRA. There are a whole bunch of IRA companies out there that make a lot of sense. And the reason I talk about this is that you can also buy multifamily or commercial syndications inside of IRAs. So you can still do the same thing without having to take on that burden of toilets, tenants, and termites. And it's easy to go through that process. So I guess the question is, if you really are curious and you need some vendors, send me an email and let's have a dialogue around what you specifically need. And I'll point you in the right direction. I don't know if that answers your question or not.
Yeah, no, that's helpful. That's helpful. I just know, when somebody thinks they're going to start this process, there's always speed bumps, right? That, kind of knock you off track, and then you spend another, you forget about it for a bit, and then you come back a week later. And so it's helpful for listeners to have a place to go to figure out, hey, you want to hit that hurdle or whatever it may be, I can get some help.
One of the things I wanted to interject on that was the big boys, Schwab, Fidelity, Merrill Lynch, Chase, those guys don't want you doing this because intrinsically you're taking money that's under management outside of their purview.
Right.
So you're going to have to look at the smaller fellas, the smaller intermediaries. And those are the ones, like in Denver, we've got a local bank called First Bank, and they do a ton of self-directed IRA work. I've got another bank, I can't remember the name of it right now. It's where I actually bank my stuff, and I would tell you if I do. But don't go to Schwab and say, hey, I want this. They do have some of them, but it's harder to get to.
Yeah.
And that's important to note.
David, do you have any predictions for the real estate market over the next 6, 12, 18 months that you could share?
Yeah, it's going to get ugly.
What does that mean?
Yeah. I think there's an awful lot of operators that have very risky debt that's going to come due. The Fed changed the interest rate 7 times by what, 400 basis points? I don't remember the exact number, but it's an obscene number, right? The highest Fed rate in 40 years. So what that means is if you had a variable rate mortgage, your costs have skyrocketed. And even if you have a rate cap, depending on what your rate cap is, and a rate cap obviously is an insurance policy that you buy to protect yourself from that variability, you got to get to that strike point to get that rate cap in place. So there's going to be a lot of operators that have been over leveraged because of bank debt. And commercial banks are on 5-year notes. So a lot of this stuff cycles through. So if you bought something 3 years ago, you're come to renewal. You might not have the process in place to actually generate a renewal on your new debt. And there you're into forced liquidation. So I see that as a possibility. I see from the residential side a flatlining in certain major metros. I don't think we're going to decrease in some metros, but we'll flatline. And our growth, which has been double digit, is going to sink to very low single digits. The consumer, once they get their head around the idea that they got to pay a 5% mortgage, can live with that. But for a whole generation of Americans, we've never seen debt that high, and they have to get their head around that. And housing prices will fluctuate a little bit to get to that stasis. But I see a lot of opportunity to buy distressed assets.
Wow. What do you mean by, taking agency?
Well, when people don't think about agency as I don't want to use the word control, because we don't have control over our lives. What we do have is control over our decisions, how we interpret the world around us, and what we use to make decisions, what our processes are, what happens in our world, how we react or proactively act in any given situation. And that agency involves things from what you do in the morning when you get out of bed, to what books you read, to what food you eat, to what vacations you choose to do. Everything we do is a decision, and people often forget they have decision-making control in their lives, and they give away their agency to their employer. They give away their agency to the financial advisor that they think knows best. And so we talked about secret powers. One of my secret powers really is helping people to know how to ask questions, to learn what it is they need to know. Financial literacy hasn't been taught well. And when I was a highly performing sales executive, I used to get a spare $50,000 a month that I didn't know what to do with. And so I had 50 grand a month I had to figure out what to do with. And I knew after the first couple months, spending it wasn't really, well, it's a first world problem for sure, right?
I'm just kidding.
Yeah. But the reality is that it was a problem because it kept piling up. I knew my stock guy. I liked him. I didn't know what the hell he was selling me. So I had to start asking questions. And my process is one I want to share with everybody else, which is to ask a question, hear the answer, vet it through your system, ask the next question, hear the answer, vet it through your system, ask another question, hear the answer, vet it through your system. And it's like sales. When you go into sales, sales is not selling something. Sales is actually a strategic structure whereby you help a client, not a customer, a client. You help a client achieve a solution that they may not have seen, and you marry their need with one of your products. And sales is not going to the car lot and having the guy say, well, this is a red car, doesn't look pretty on you. That's manipulation. And there's a big difference between that. And in the investing world, the financial people come out and they say, well, you need to be diversified. And how many of us know what that really means? That might not be the right solution for you. And when you're an investor in the real estate marketplace, the same applies. Someone looks at, I want an IRR of 18. What does that mean for them? What are the accomplishments they're trying to do?
They've just heard somebody else say that most of the time, I think.
Yeah, right. They've heard it talked about. And so they want to sound intelligent.
Yeah.
And they want to sound knowledgeable. I know when I had a spare 50 grand a month, I was scared to ask my broker, what the hell do you mean mid-cap? What's a mid-cap company? What's a small cap company? Why does a small cap always lead a recessionary return? And so They do all these things and they throw it at us, and we don't understand it. And my experience is that we don't understand it because we don't know the questions. And I'm working very diligently to create bespoke questioning that matters, and so we can create financial literacy for ourselves. I had a client recently who was had $80,000 in his pocket. I can put him into a syndication. I can help him buy the rental he wanted to buy. So we sat down and we talked for 2 hours. Turns out he was putting an extra $2,000 a month in principal against his primary residence. Does that sound good? I mean, the reality is, if you're a fan of Dave Ramsey, it sounds fabulous because you're retiring your debt. But what you're doing is he had a mortgage at 3%. So his financial literacy was basically, his financial illiteracy was killing him. He was paying down debt at 3%, which means that if he could invest at 8% on something with leverage, he was wasting 5% of his compounded growth of his money every month. Long story faster, we talked about it. We figured out what his problems were, figured out what his goals were as well, quit paying down all that principal on his house, took that $80,000, decided it wasn't enough money to buy a solid rental that he wanted to have with the right tenant base he wanted in the Denver metro where he lives. So instead, he bought a new primary residence with that $80,000, and that spared $2,000 a month he had been paying. He increased his debt, but he also increased his asset value. The day he closed, he made $200,000 more in net worth. Now think about that. If you just listen to people and ask questions, it influences everything. And so this client of mine hadn't asked the question, what's the situation for me? So I challenge all the listeners out there to start asking different questions. And it's not the 20 questions that you have on the website that say, here are the 20 questions you must ask a syndicator to know if they're the right guy or not. You know what? Every syndicator writes their 20 questions, and they're going to write them so that they can answer yes to all of them. But what's more important to you as an investor? Those are the things that we have to get to. How do we learn what is the right way to ask a question? So, for example, if I'm going to buy
ask you that.
Yeah, fire away.
Well, I mean, I want to ask you, like, help us think through asking those questions, so we can gain that financial literacy, for our investors that are listening, no matter what operator or broker, whoever they're speaking to, right? I guess help us with some thinking. I love how you said, it's not just this list of 20 questions, right? Because it could be different, obviously, depending on what operator or deal, whatever, all these factors that we could take into account. But then it's also going to change depending on the responses maybe that you get as well, right, from someone.
Right.
And so I guess help us think through that a little bit, David, to give some practical steps maybe to the listener and myself.
So some macro categories: risk tolerance, right? Are you a 30-year-old that can have a 30-year horizon, or are you a 60-year-old? And what's the risk tolerance? Then also think through, what are the trends that you think are going to continue to improve in the marketplace to create value? So if you think housing is a good trend, then you probably shouldn't be looking at self-storage if housing is a better trend. So part of this is to create goals. There's the risk factors, there's risk tolerance, there's goal setting, there's your investment hypothesis. If you start investing without a hypothesis, then you're just gambling. No scientist is going to start doing an experiment without a hypothesis. And the irony of this is that David talking science is kind of strange because I'm a fine arts, I'm a language arts guy. But think about this. If we're going to invest, we need to have a hypothesis. So I passed on cryptocurrency because my hypothesis was that it wasn't needed in first world countries, and it was going to be a deregulated area fraught with crime and fraud in third world countries. I missed a lot of money, but I never worried about my investment. And that was okay. I was good in my shoes because of that. But at the same time, when SBF got caught and the house of cards crumbled, I didn't take any risk. So that wasn't in my risk aversion set. So as we think about what it is, we lay out all those core things: strategy, timing, risk aversion, and then we go dive in deeply. So if I'm going to be a multifamily investor, I'm going to ask, where do I think the right markets are? Why do I think those markets are right? What's important to me? Because the syndicators often say, here's what's important to them, but it might not be the same things as what's important to the investor. And I think the crucial part of this is for the investor to think through what matters to them and why. I have a friend of mine that's an investor, and she was investing private equity into a real estate company. And we both got the same offering. And I turned it down because it was a 400 times valuation of cash flow. And I did the math and I said, I'm not going to give that guy money at a 400 times cash flow valuation, no matter what. She's like, oh, it's a great deal. I trust the guy. So her mechanism was trust. My mechanism was mathematics. Neither is right nor wrong. And I think it's about knowing yourself. And that's a part that people ignore. When we dig into why do we buy a stock, Warren Buffett says we invest what we know. Right. And so if we're going to buy a stock and we don't know anything about hedge funds, is it wise to buy into a hedge fund? Quite probably not. The difference between investing and gambling is very small. And so my challenge to everybody is to start asking different and deeper questions.
Yeah.
And for example, if you're running an Airbnb, I had a guest on my podcast recently, and they were talking about one of the questions that they use, and I loved it. And the question was, do you have a quality control inspector enter every unit post cleanup from the housekeeping service? I thought that was a great question because it tells you a ton of different things. It tells you, A, do they have the size to handle detail? Are they detail oriented? Are they looking at the customer experience? If the customer experience is not important to the investor, maybe it doesn't matter. But if the customer experience is important to the investor, it really does matter.
Yeah. I wanted to go back just a little bit there where you mentioned, investors need to know what matters to them and why. Even going back to you mentioned earlier, risk tolerance and thinking about age and the trends you believe. And I think often, people may come into some money or maybe they even make some money, right, in some way, and they don't know to even think through those things that you just laid out.
Right.
As simple as some of
Right.
those are, think about their personal risk tolerance before they make that, say, $50,000 investment, right? In whatever they're investing in, but even outside of the asset itself, but even them personally, and thinking about, even their something as simple as their age or their personal goals, for their own finances.
I've got a draft written right now of a blog post that I haven't quite finished yet, which is basically going to be, what's your risk number and how do you get there? We just exited an offering and the cash came into the operating company, and then it went through the property management company to distribute back to our investors. And it took a little bit longer than we thought. And I had two investors who were really anxious to get their returns. And it was a really seminal moment for me because it reminded me that I probably shouldn't have had those two investors in the portfolio because they were dependent on that for other expenses. And if you're investing in long-term holds, and then you're dependent on that investment for daily living, those goals might not be in alignment with your actions.
Right.
If you're going to buy an illiquid investment, but you need liquidity, that's one of those things that people need to think through. And often they don't. Let's say it's your first $50,000 inheritance and you don't know what to do with it. You got to start asking questions, and one of the ways I practice this is that I think through what happens if I win a lottery. Do you realize that almost every lottery winner goes broke within 2 or 3 years?
Yeah, it's very unfortunate.
Right. And it's a combination of things. Part of it's probably getting scammed. Part of it is probably not thinking through what would happen when. And if we can think through, why would I need X? My daughter is a rising junior at Rutgers, and she's discussing with me where she's going to go next. So the question becomes, what are you going to do? And she goes, oh, I might go to grad school. I might go to law school. I said, why would you want to be a lawyer? And her answer was, because I'd be good at it. And that's a natural thought process, right? But what's the next question after that? What would it light you up? Would it be passionate? Would you enjoy it? Are you fascinated by the law? So when you're investing, are you proud of your investment? Do you want to share in what that is? So it's not always the math. And I think that's an important part of it. I've passed on a lot of investments in Southern Florida because I was alive during Hurricane Harvey as an adult. And I watched Hurricane Harvey decimate the Miami area. And I know that insurance costs are skyrocketing. So one of the questions I'm going to ask if I'm looking at a property in the Southeast is, what's the rate of change of the insurance rates? And that might not be a question that's as applicable in the Pacific Northwest. So I think a lot of this comes down to the geography you look at and where you go. If you're going to buy in Central Virginia, I'm going to ask what the population migration's like in the Roanoke Valley. Because it's different than it's going to be in Kansas City.
For sure. Yeah, no doubt about that.
Right.
Very different. Yeah. Well, no, that's I want to go back and ask you a couple things, David, because you talk often about the golden handcuffs. We're kind of we briefly talked a little bit about that, but and just with a few minutes here, I wanted you to be able to help the listener with thinking through even creating that plan, right, to get rid of those golden handcuffs, right? I want us to at least briefly talk about that to get them thinking about that as well. But let's start down that path a little bit as far as just helping them create that plan. And some of that even is what you talked about, thinking through the risk tolerance and the trends and the things we've been talking about. But I wanted you to elaborate there a little bit.
Yeah. So golden handcuffs really are a place where you're stuck in your employment for one reason or another, and you don't want to leave, or you cannot leave for one reason or another. So I think the first part about breaking those handcuffs and turning them into positive bracelets is deciding that they're going to be bracelets, not handcuffs. And the first part of it is creating a mental mindset shift that says, this is a good thing. I'm trapped, sort of, but I'm not completely trapped. And then from there, it's starting to lay out a plan. And that plan includes, what are my goals? How am I going to implement those goals? Who do I need to help me? Find a mentor to go through that process. Take action. It's really kind of that simple, but it's far more complex than that. And I don't have the book written yet. I'm working on it. And the reason I haven't completely written the book is that what I have found in talking to people on my show is that everybody's created a slightly different plan. And the ones who are successful have all started with a mindset shift that I can use this to my benefit. When I wore golden handcuffs, I spent a lot of time figuring out how I could turn it around into an improved lifestyle and other metrics. Yeah, I only had 2 weeks of vacation or 3 weeks of vacation, or by the end, I had a month of vacation. So I didn't have complete agency over my time. However, I did have agency over where I could spend my free time. And then I had agency over how I could raise my children. And then I had agency over my financial life. So that when the time came, I built a structure that allowed me to say, I'm going to transition from career 1 to career 2 to career 3. And it totally depends on what your vocation is. A pilot's plan is going to be very different than a software engineer's plan.
For sure.
And, yeah.
Yeah, for sure. I think so many things can be broken down on what you just said there. It's like the mindset, right? Decide they're bracelets and not handcuffs. I mean, so much starts right there, with your decision, I think, mentally, right? But the goals and how to implement them, kind of reverse engineering. And then it's such an important piece too. You mentioned, and I've seen this personally so many times, is finding mentors and people that can help support you, right? That are ahead of you. That's done so much for me in so many aspects of my life. And once I started to realize that in one aspect, I'm like, okay, I got to find some of these mentors that are ahead of me in these other places as well, in my life.
Yeah. And I've come to that learning probably later in life than I should have. I think that the cultural dialogue now is more around mentors than it was in the 90s.
Yeah.
When I started the workforce. And in the 90s, the thinking was, you get into work, you get a job, and you stay on, and you'll be okay. The reality is that the average American changes careers 5 times. Careers, not jobs, careers. And as we think about that, I think it empowers us to say, hey, I've got golden handcuffs today. Tomorrow, I can turn those into my new business. And I interviewed a person who had lost their job. And because they lost their job, they were able to start their new business. And from
Didn't
that,
have a
they've
choice.
blossomed.
Right.
Well, no, but they did have a choice. They could have taken that severance package
Yeah.
and gone to the next job.
Yeah.
You know, and like when I lost my job, I made the decision to go into tech, from advertising into tech. And it was an experiment. It didn't work for me. Okay, keep moving. So you got to have that mindset that it's an opportunity field, not a limited, narrow road in front of us.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing.